Structured financial instruments represent a very broad sector, but based on everything that I have seen and read, I have seen almost every instrument other than a regular bond be referred to as a structured instrument. So asset-backed securities are structured instruments, collateralized debt obligations are structured instruments, mortgage-backed securities, which are actually a subset of ABS, are also structured instruments, and these instruments are discussed in other readings. The sorts of structured instruments that we focus on in this reading are shown right here. So we will understand these four categories with examples. Let us start with capital protection instruments. Say an investor has $100,000 to invest and he buys a government bond. So this is a bond with no credit risk, which pays a par value of 100,000, and the value today of this bond is 99,000. So he'll pay 99,000 and after 1 year he will get 100,000. He can then take the remaining 1,000 and use this money to buy call options on some stock. Now notice what happens. He invested a total of 100,000 and his return here is guaranteed in the sense that he has preserved his capital. That's why we say this is a capital protection instrument. But at the same time, since he has bought call options, he also has upside potential. If the underlying stock goes up, then he makes a lot of money based on these call options. Now, the example that I gave here can also be called a guarantee certificate because this structure ensures that at the end he'll get at least 100,000, which is the investment amount. Obviously, capital protection instruments can be set up to offer different levels of capital protection. Next, we come to yield enhancement instruments. And a classic example of a yield enhancement instrument is a credit-linked note. So say we have an issuer who issues a credit-linked note and an investor buys this credit-linked note. The credit-linked note can be thought of as a bond which is tied to an underlying asset. This underlying asset is called a reference asset. Now, this credit-linked note is like a bond which will make regular coupon payments, and then the final par value payment will depend on whether a certain credit event has occurred. Say the credit event is defined as a downgrade of this particular reference asset. If that downgrade happens, obviously the value of the reference asset is impacted, and that in turn has an impact on the par value which is paid. If there is no credit event, then the investor is going to get the regular coupon payments and the regular par value. If there is a credit event associated with this reference asset, then the par value received at the end is lower. Now notice in this setup, the investor is taking on the credit risk of this reference asset. So that's the risk being taken. What's the return? The return is in the form of relatively high coupon payments. Credit-linked notes will have higher coupon payments compared to otherwise similar regular bonds. Also, credit-linked notes are likely to sell at a discount. So in addition to the relatively high coupon payments, there is also going to be a capital gain as long as there is no credit event. If you have studied credit default swaps, then this will look familiar because in essence, a credit-linked note is a combination of a bond and a credit default swap where the issuer is buying the protection and the investor is selling protection. If you did not understand the part about credit default swaps, don't worry about it too much. The core point is that with yield enhancement instruments, the investor is taking on more risk, specifically more credit risk, and is being compensated with a higher return. Participation instruments. Such instruments allow investors to participate in the return of an underlying asset. The classic example here is of a floating rate bond. With a floating rate bond, the investor benefits if the interest rates go up. So in essence, the investor is participating in interest rate movements. When the interest rates go up, the investor will receive a higher coupon payment. Many participation instruments are designed to give investors indirect exposure to a particular index or some asset price. The final category we need to study is leveraged instruments. These are structured financial instruments created to magnify returns, and these instruments offer the possibility of higher payoffs from small investments. A classic example here is an inverse floater. With an inverse floater, the coupon payment is inversely related to some reference rate. So the inverse floater coupon rate is generally based on this sort of formula. It is C minus L times R. C is the maximum possible coupon rate possible. R is the reference rate, and L is the coupon leverage. So let's take an example given in the curriculum where they say that at some point the Royal Bank of Scotland issued inverse floaters based on a formula of 8% minus 3-month LIBOR. The leverage factor there was 1. Now in this case, if LIBOR goes down, then the coupon rate or the coupon payment goes up, because as LIBOR goes down, then 8% minus a smaller LIBOR gives us a higher number. On the other hand, if LIBOR goes up, then this number will come down. The L, as I said, is leverage. If the leverage is between 0 and 1, then this is called a deleveraged inverse floater. On the other hand, if L is greater than 1, then we would call the instrument a leveraged inverse floater. Inverse floaters often have a floor that specifies a minimum coupon rate. For example, a floor may be set at 0 to avoid the possibility of a negative interest rate. So that is it for this slide. Make sure that you know these 4 categories along with the major examples of each category. Now let's look at example 7 from the curriculum. If an investor holds a credit-linked note and the credit event does not occur, the investor receives, and here the correct answer is A. So if the credit event does not occur, the investor gets all the promised cash flows as scheduled. Now, as I mentioned earlier, with a credit-linked note, these cash flows are likely to be higher than an otherwise similar regular bond because the investor is taking credit risk. Here the investor got lucky and the credit event did not happen, so he will get a relatively high return. A structured financial instrument whose coupon rate is determined by the formula 5 minus 0.5 times LIBOR is most likely. Now clearly this is an inverse floater, and since this leverage factor is less than 1, we have a deleveraged inverse floater. So this is the best answer. This section deals with how banks raise funds in the short term. The obvious method is through retail deposits, and this would include both commercial deposits as well as individual deposits. Generally, retail deposits represent the lowest cost source of funding for banks. Next, we come to short-term wholesale funds, and the 3 broad categories here are central bank funds, interbank funds, and certificates of deposit. Let's understand first what central bank funds means. If you recall, in economics, we studied the fact that when a bank receives money from depositors, some of this money needs to be put into a reserve account at the central bank. Now, if this bank is running low on cash and depositors come to the bank and want to withdraw some money, then what the bank can do is withdraw from its account at the central bank. This is one situation. Another scenario is where the bank wants to withdraw from the central bank, but there is not enough money or not enough funds in its account at the central bank. Then what the bank can do is borrow from other banks. Other banks also have deposits here at the central bank. So there might be Bank 2, which has deposits here, and Bank 2 has deposits that exceed the minimum required amount. Bank 1 can then, through the central bank, borrow from Bank 2. The rate used in this context is called the central bank funds rate. If borrowing happens for 1 day, then we refer to this as overnight funds. If borrowing is for more than 1 day, then we refer to this as term funds. The third and final category of short-term wholesale funds that we look at is shown right here, certificates of deposit or CDs. A certificate of deposit is an instrument that represents a specified amount of funds on deposit for a specified maturity and interest rate. So notice that the period is specified. You might have a 3-year CD or a 5-year CD, and the rate is also specified. Within CDs, we can have two forms, negotiable and non-negotiable. With a non-negotiable CD, the depositor is not allowed to take out money before the maturity date, and if the depositor does withdraw, then a fee needs to be paid or there is a penalty. With a negotiable CD, the depositor is allowed to sell the CD in the open market and get his funds. Next, we come to repurchase agreements, also called repos, and reverse repurchase agreements called reverse repos. This is important because these instruments are used extensively. First, let's understand the definition. A repurchase agreement or repo is the sale of a security with a simultaneous agreement by the seller to buy the same security back from the purchaser at an agreed on price and future date. If you read this carefully, this is effectively like collateralized borrowing. So if we have two parties, A and B, what A might say is that I will sell you a T-bill today for $99.50, which means that A is giving B the T-bill, which is collateral, and B is giving cash, let's say $99.50. And then A says that tomorrow I will buy that T-bill back from you at $99.51. So if this is day one, the next day what happens is that A is going to buy the T-bill back. So B will give the T-bill back to A, and A is going to return $99.51. So this effectively is a way for A to borrow $99.50. The next day A is paying $99.51. The 1 cent is the interest and the T-bill is the underlying collateral. Here is an example from the curriculum. A dealer sells the 2.25% UK gilt. This is the short-term UK government instrument analogous to the T-bill in the United States that matures in 3 years. Actually, since this matures in 3 years, this would be analogous to a treasury note. To a counterparty for cash today, at the same time, the dealer makes a promise to buy the same gilt the next business day for an agreed price. So this is almost exactly like what I just described, but this is from the curriculum. So let's understand a few important terms. What I described is the repo. The transaction was a repo from the perspective of Bank A because Bank A was the bank which was making the commitment to repurchase. From the perspective of bank B, the same transaction would be called a reverse repo. Repurchase price, in my example, there was a price at which A was promising to repurchase the next day. So that price is the repurchase price. Repurchase date, again, in my example, the repurchase was happening the next business day. So that would be referred to as an overnight repo, where the repurchase is happening the next day. If the repurchase is happening 2 days later, 3 days later, in fact, anything more than 1 day later, then this is referred to as a term repo. The repo rate is the rate which is implied by the two prices, the amount of money that A gets initially and the amount of money that A is eventually repurchasing the underlying asset for. The combination of those two, or the difference between those two numbers, can be annualized, and we compute the effective interest rate. That rate is the repo rate. The next thing we look at is the set of factors which impact the repo rates. And those factors are given right here. If the risk associated with the underlying collateral is high, that causes repo rates to be higher. Term of repurchase agreement, typically if the term is longer, then the rate is higher. Delivery requirement, in the example I just described, the underlying collateral was actually delivered. There might be scenarios where the underlying collateral is not delivered. And as you might imagine, if the delivery requirement exists, in other words, the underlying is delivered to the counterparty, then the repo rate is lower. Supply and demand of the collateral. If the supply of the collateral is relatively low, in other words, the collateral is scarce, then the repo rate is lower. The reason is, if the supply is low, then clearly the collateral is valuable. And since the collateral is valuable, the rate is lower. And finally, the interest rates of alternative financing also impact repo rates. When we deal with repos and reverse repos, both the counterparties or both the participants are exposed to credit risk. This is the case even if the underlying collateral has virtually no credit risk. And to understand how this can happen, consider the following situation. Let's say we have a dealer who is the borrower and an investor who lends money. In a 5-day repo, we have a situation where the dealer initially sells the T-bill for a certain amount of money, let's say 99.50. So the dealer gets the money and the investor gets the collateral, which is the T-bill. Now at maturity, let's say that the dealer defaults. In other words, the dealer now needs to repurchase the T-bill, but the dealer defaults and does not repurchase. And at the same time, the price of this T-bill might have gone down. Let's say interest rates in the market went up and the price came down. So now the investor is stuck with a T-bill at a price lower than the price that the dealer had committed to buy back this T-bill at. So that is the credit risk faced by the investor. What about the other situation? Let's say that the investor at maturity is unable to deliver the T-bill. So the dealer still has this money, but let's say that the price of the T-bill has gone up now. So here the situation is that the dealer is stuck with this money, but the collateral that was rightfully his is not being returned, and the value of that collateral is substantially more. So both parties face some credit risk. The way repos are structured though, the lender, in this case the investor, has greater exposure to credit risk. And the difference between the market value of the collateral and the value of the loan is called the repo margin or haircut. In fact, the way this is structured is that the value of the collateral is less than the value of the loan, and that is why the lender has greater exposure to credit risk. And the difference is called the repo margin or haircut. This term is used in the United States. The level of this margin or difference depends on the length of the repurchase agreement, the quality of the collateral, credit quality of the counterparty, and the supply-demand conditions of the collateral. And just to make the relationships explicit, the longer the repurchase agreement, the higher the repo margin. The higher the quality of the collateral, the lower the repo margin. The higher the credit worthiness of the counterparty, the lower the repo margin. And repo margins are lower if the collateral is in short supply relative to demand. Which of the following are not considered wholesale funds? And we've just been through this. Interbank funds and central bank funds are both wholesale funds. Repurchase agreements are separate. They are not considered wholesale funds. For a deposit-taking bank, wholesale reserves with the national central bank is a requirement, an opportunity cost, an opportunity to receive interest on excess funds. This is a tricky question. Option C can be ruled out, and what we are left with is A and B. In many countries, putting money in the central bank is a requirement, but this is not the case in all countries. However, placing money in the national central bank definitely entails an opportunity cost, so B is the best answer. A large denomination negotiable CD of deposit most likely is traded in the open market, is purchased by retail investors, has a penalty for early withdrawal of funds. Here again, C is obviously not the right answer. So we are left between A and B. And as we discussed, with a negotiable CD, the depositor has the option to sell this in the market to another investor. So these negotiable CDs are traded in the open market. The best answer therefore is A. From a dealer's viewpoint, a repurchase agreement is best described as, here the best answer is B, collateralized short-term borrowing, and we have talked about this. The interest on a repurchase agreement is a repo rate, and we've also talked about this. The level of repo margin is higher under which of the following circumstances? Higher quality of collateral. Actually, high quality of collateral causes the repo margin to be lower. Higher credit quality of the counterparty. This also causes the repo margin to be lower. The longer the length of the repurchase agreement, this causes the repo margin to be higher. So the best answer is C. Let us now summarize the main points from this reading. You need to understand the different classifications of fixed income securities. Securities can be classified based on issuer. So there we can have government bonds, we can have corporate bonds, and so on. We can also have classifications based on credit quality, classifications based on maturity, classifications based on geography. So there are several different ways of classifying fixed income securities. You need to understand the concept of interbank offer rates. The most well-known interbank offer rate is the London interbank offer rate. This is the rate for unsecured borrowing between banks. The mechanism for issuing bonds in primary markets, there are a few different methods. There is a best effort method where effectively the investment bank is playing the role of a broker. If we have an issuer and investors, in a best effort scenario, the investment bank is trying to broker a deal between the issuer and the investor. Another scenario is an underwritten offering. With an underwritten offering, the investment bank buys the bonds from the issuer at an agreed upon price, and then the investment bank is responsible for selling those bonds to investors. The risk with an underwritten offering is taken by the investment bank. We can also have auctions. Auctions are often used in the government bond market. In the corporate bond market, the methods used most often are underwritten offering and best effort offering. Secondary markets are markets where investors buy and sell bonds to each other. After the bonds have been issued in the primary market, they then trade in the secondary markets, and here investors are buying and selling bonds. When bonds are bought and sold in the secondary market, funds do not go to the issuer. Debt issued by sovereign governments, non-sovereign governments, agencies, supranational entities. So these are all government-related entities. The credit risk is generally the lowest with sovereign governments and non-sovereign governments. Agencies are entities that are created by governments. These agencies also issue bonds. Generally, their credit rating is low, but not as low as the credit rating of sovereign governments. And then supranational entities are entities like the IMF and World Bank. Companies can raise debt in different ways. Companies can either borrow directly from banks, or companies can issue short-term bonds, long-term bonds. Some large financial institutions also issue commercial paper. A repo or repurchase agreement involves the sale of a security, which is the collateral, with a simultaneous agreement by the seller is also the borrower, to buy the same security back from the purchaser at an agreed on price in the future. This is effectively like collateralized borrowing. You need to understand repos because they are extremely common. That brings us to the end of this reading. As always, I want you to read the summary, review the learning objectives, make sure you can say something sensible about each of the learning objectives. We have done all the examples. The examples are very good. I want you to come back to these examples at a later point in time and make sure you can do them. Do the practice problems in the curriculum and do practice questions from other sources.